It starts with a big idea, something new, disruptive, revolutionary. A couple of founders in a dim room, running on ramen and Red Bull, staring at a half-broken app they swear will change the world. It's not a business yet. It's not even a product. It's a possibility. But in the startup world, possibility is a currency. What they have now is a pitch, and that pitch is their ticket to survival. They hit the ground, chasing seed funding. The first major injection of money to take a raw idea and turn it into something real. Seed funding usually comes from angel investors or pre-seed venture capital firms. These are risk takers, people who are willing to bet big money on a tiny team with zero guarantees. In exchange, the founders give up something precious: equity. A slice of ownership in their company. So if a founder raises $500,000 in seed funding at a $2 million valuation, it means the investors now own 25% of the company. It sounds harmless, but that number, it grows over time. Each funding round gives away more equity, and every new investor expects a bigger return. The money hits the account, the race begins, they start hiring, building, advertising, hoping, but now they're on the clock because every startup has a runway, the amount of time they can survive before the money runs out. If a company is burning $50,000 a month and raised $500,000, they have 10 months to live. That's the runway. This is where burn rate matters. Burn rate is the speed at which they're spending investor money. The higher the burn rate, the faster the runway disappears. And trust us, most startups burn fast. This is the pressure cooker. Every day is a sprint to prove one thing: traction. Can they get users, keep them, make them pay? They don't need to be profitable, not yet, but they need to look like they could be someday. What if they do? They move to the next stage, Series A funding. Here's where it gets real. Series A is the next round of funding, usually from larger venture capital firms. At this point, the startup has to show solid metrics: growth, retention, a business model that can scale. Series A rounds are bigger, usually $2 million to $15 million or more. But now it's no longer about dreams. It's about valuation, how much the company is worth on paper. Let's say the company raises $10 million at a $40 million valuation. That means investors are buying 25% of the company, and the pressure is now 10x greater because this money is meant to scale fast, more engineers, more marketing, more everything. Now they're not just trying to survive, they're trying to dominate, because if they don't grow, someone else will. And so the company enters the funding cycle: seed round, Series A, Series B, Series C, maybe IPO or acquisition. Each round brings more cash, more growth, more dilution. Dilution means the founders own less and less of their company over time. That's the trade-off. You grow fast, but you give up control. Meanwhile, the valuation skyrockets. The company might not make any profit. It might be losing money every single day. But if the market believes it's valuable, the funding keeps coming until it doesn't. Because here's the brutal truth: 90% of startups fail. They either run out of money, or the product doesn't stick, or the team falls apart, or someone with more cash, more talent, and better timing builds it faster. It doesn't matter how good the idea is. What matters is, can you grow it, fund it, and scale it fast? The graveyard of startups is filled with brilliant ideas that never reach Series A or B or anything at all. And yet, even failed startups can make people rich. Because in venture capital, it's all about the portfolio. If one startup becomes a unicorn worth over $1 billion, 0 cents, it pays for the 20 others that died. The founders might walk away broke, or they might sell the company in a quiet acqui-hire where a big tech firm buys the team and shuts the product down. Some leave with stock, exit money, or new roles at better companies, and the cycle resets. Someone else gets inspired, builds an MVP, raises a seed round. The countdown begins all over again. The reality is, startups aren't built for safety. They're built for speed, for chaos, for risk. They trade stability for scale, security for ambition, sleep for the chance to become a legend. Because deep down, every founder knows they're gambling on themselves, on their team, on the belief that they're building the next unicorn, not the next failure. So next time someone tells you they're working on a startup, don't just nod at them. How long until you run out of money? Because in the world of startups, you're either building a rocket ship or digging your own grave. And the difference is only a few funding rounds apart. Like this. If you finally understand how startups really work, comment below, would you risk it all for an idea? Subscribe for more deep dives into money, tech, and untold business truths.